2, where we review the basics of a financial statement. What do financial statements contain? And then how do we analyze? How do we infer from what the numbers are presented to us? So we are going to be starting by looking at, first, noting that financial statements are essentially accounting reports that are required by law to be periodically submitted for publicly traded corporations. If you are privately traded corporations, you don't have to disclose your financial records. But if you're a publicly traded corporation, then you have to file these accounting reports on a periodic basis. They're required to be filed at least once a quarter, and we call them 10Q reports. And then an annual report that is called a 10K report. So if you go to the SEC website, they will provide you with the 10Q reports and 10K reports for all publicly traded corporations. Public solicitation of money cannot be made by corporations without requiring them to file these 10Q and 10K reports. The preparation of financial statement follows what is called the generally accepted accounting principles, or what we call the GAAP standards, or the GAAP principles, and they are set by the Financial Accounting Standard Boards, or FASB, and they essentially provide us with a common set of rules, which is important. Once we know what the common set of rules are, then we can make comparisons between different financial statements. And they are required to hire an auditor, an independent auditor, who will certify that the information that is presented in the financial statements are indeed correct. One interesting note over here, after the passage of the Sarbanes-Oxley Act in 2002, that included a standards that makes the U.S. financial accounting standards converge to international standards. And it requires that financial information that is provided is certified by the CEO of the corporation that it is indeed correct, and if it is not correct, then CEO would be personally liable for that incorrect information. So the first thing that we look at in a financial statement, the first statement that we look at is called the balance sheet. And the main items that make up the balance sheet are the following. On the left-hand side, we have assets, and on the right-hand side, we have liabilities, and then equity. And all balance sheet will have to comply with the following identity, that assets on the left-hand side have to equal the sum of liabilities and equity on the right-hand side, as you see over here. The assets equal liability plus shareholder equity. Under assets are divided into two broad classes, current assets and long-term assets. Under current assets, we have these three major items: cash, accounts receivable, and inventory. And under long-term asset, the main item over here is fixed asset, net property, plant, and equipment. On the right-hand side, under liability, we have two types of liability. Current liability, mainly made up of accounts payable and notes payable, and then long-term debt, which is long-term liability. And under equity, we have common stock and paid-in surplus, and we have retained earnings. So these two together make up our equity. So the assets indicate everything that the company owns. Liabilities and stockholder equity indicates everything that the company owes. It also tells us that what the company owns are essentially financed through short-term or long-term debt or stockholder equity or equity. So that's another way in which you can view what the balance sheet is telling us. Okay, what are the items now? Under current assets, cash. Cash indicates things that are either cash, tangible cash, or marketable securities that are securities that can be converted into cash easily, that can be easily sold or converted into cash. Accounts receivable are items that tell us the amount that is owed to the firm by the customers who have purchased the goods from this firm, goods or services from this firm. And they are purchased those goods and services on credit. So accounts receivable indicates items that have been sold or services that have been performed, but for which payment has not yet been made. Inventory indicates the raw material or work in progress and finished goods. And then there could be smaller current asset items that include things such as prepaid expenses. But the three major items are these three: cash, accounts receivable, and inventory. On the long-term asset, what we are looking at are assets that are tangible, generally tangible, and that assets are acquired not for idle purposes, but they're acquired for the purposes of producing benefits down the road. And the value of these assets are reduced yearly through a legal deduction that the company can take, what we call depreciation. So a part of the value of that long-term asset can be reduced or will be reduced every year through a preset depreciation schedule, which depends upon the type of asset and the asset's life. But we have to realize one very key point: depreciation is not a cash expense, meaning there is no actual cash outlay associated with depreciation. Depreciation is simply a charge that appears on the accounting statements, on the financial statements, that allows us to reduce the value of that asset by a preset amount. And then later on, we will see that depreciation allows us to also reduce our tax liability. And the understanding over here is that the company is setting aside a fixed sum of money every year so that when the asset becomes older, they are able to replace that asset, so that they have money available to replace that. That's kind of the idea behind the depreciation. One other key point to remember, that on a balance sheet, all items that we are seeing over here are being represented in what is called their book value. Book value indicates that the value that is on the books on the day those assets were acquired or those liabilities were incurred. They are not restated. In other words, if a particular building was acquired at a certain date, then under long-term assets, under net property, what we see is the value of the building as of that particular day. Given the fact that the value of the building could have changed over time, that change in the value of the building is not reflected on the balance sheet. That's why every item on the balance sheet is stated in its book value. That's very key to remember. Okay, under liabilities, the main items that we have are accounts payable, things that the company may have acquired but has not yet made payments to their suppliers, because those items were acquired on credit, so the company may have 30, 60, 90 days to make those payments. But the company is liable for them, but they have not yet fulfilled that liability. Notes payable and short-term debt indicates anything that must be repaid in the next year. Okay, any loan that has to be repaid within the next year will be classified under notes payable or short-term debt. And then there are certain items called accrual items. Items such as salary or taxes that are owed but have not yet been paid. For some reason they are deferred, may have been some deferred payments in it, so they are owed but not yet been paid. If I take the difference between current assets all the things that are either cash or cash type that the company owns, and subtract current liabilities, all the things that are cash or cash type that the company owes. The net of that is called net working capital. The difference between those two are called net working capital. Net working capital, in some sense, indicates the float, the cash float that the company has between what it has on hand and what it has to pay up within the next 1 year. Long-term liabilities are long-term debt. These are a loan or debt obligation that have a maturity of more than a year. And if I take the difference between all my assets and liabilities, that will give me the value of my equity. As we have talked about before, equity is what the shareholders or the owners of the corporation have invested in the company as their ownership claim on the company. Market capitalization is very important for us to realize, because everything on the balance sheet is stated in book value terms, and because valuation changes over time, it is important for us to realize the difference between market value and book value. And to realize that, I have to calculate what is called the market capitalization of equity. And to calculate the market capitalization of equity, I will take the market price of share, P, and multiply that by the number of shares outstanding. That will give me market value. And if I take the ratio between market value and book value, I get an indication by how much the value of the assets have increased in the market above and beyond what it was acquired at the time those assets were acquired. So here is an example. If a company has 3.6 million shares outstanding and they're trading at a price of $10 per share, what is the market capitalization? Market capitalization is equal to the price of the share times the number of shares outstanding, which would be 3.6 million times $10, that is 36 million, is market capitalization. What is the book value of equity? To calculate the book value of equity, I have to go back to the balance sheet and see that the book value of equity I can see over here that the book value of equity is captured over here. 22.2 is the book value of equity. So now if I take the market value of equity that I just calculated over here, 36 million, divide that by 22.2 million, I get the ratio. I get to what extent has the market value increased. The value of the company increased in the eyes of the market participants, in the opinion of the market participants, above and beyond what the value was when original shareholders or owners had invested money into this company. Okay. So we have covered market capitalization. So the market to book ratio, market value divided by book value. Sometimes this market to book ratio is also called the price to book ratio. Sometimes it is simply classified as M over B. And we sometimes use this ratio, this M over B ratio, to indicate whether the company is value or growth. Meaning, the simple idea over here is that companies that have high market to book ratio means what? That the stock price of the company has increased significantly above what its original value was. And why would the stock price increase? Because the company has faced excellent growth prospects. So thus, companies with high market to book value ratios are described as growth firms, whereas companies with low market to book ratios are described as value firms. So we can see over here the different types of market to book ratio for different classes of firm. Notice that on the high end are companies that are in the tech sector. Companies that have extraordinary possibilities, their market to book ratios are astronomically high, 10, 12, 14 times above their current value. On the other hand, when you look at financial companies or financial service firms, which are much stabler, their market to book ratios are in the two times, about two times. The market value is about 2 times the book value. So that means these companies would be considered as value companies, whereas these companies would be considered as growth firms. From once I have market value of equity, I can add to that the value of debt, subtract the value of cash, and I will calculate what is called the enterprise value of the firm. Because what enterprise value shows is that market value of equity is what equity holders are willing to pay to acquire the stock of the company, what debt holders are owed at that point in time, minus cash, which indicates the liability that the firm has, because the cash will have to be paid out. So that will give us what is called the enterprise value of the firm, which is the value of the underlying business assets unencumbered by debt and separate from any cash or marketable securities. So it gives us a more realistic value of the overall enterprise, of the overall firm. So over here we can take a look at an example. This company has a share price of 72.36, a market to book ratio of 7.66, a book value of 4,984 million, and a cash value of 1,100.7 million. What is market capitalization and what is its enterprise value? So share price 72.36, number of shares outstanding 320.7 million, cash 1.1 billion, and debt 4.98 billion. So market capitalization is the share price multiplied by the number of shares outstanding. That gives us 23.2 billion. And enterprise value is the 23.2 billion plus the 4.98 billion, which is from the debt, 4.98 billion from debt, minus 1.1 billion in cash. So that's the value of the enterprise or the firm today. Okay, let's skip that. Similar problem, you can work that on your own. Let's take a look at another type of statement that we have called the income statement. So beyond the balance sheet, which essentially represents a snapshot in time, we also have what is called the income statement, which is the statement of flow. It tells us how money came in and how the money was spent after it came into the firm. So it indicates for us a measure of profitability for the firm. By how much is the firm profitable? So income statement is also called the profit and loss statement or simply a P&L. And the bottom line is essentially what the income of the firm has been. Okay, it shows us the net income of the firm or the earnings of the firm. So let's look at what are the items that we have over here. We start with net sales. Net sales indicate everything that the company sold. It captured that value of the sale. That's 186.7 in 2013. Cost of sale indicates the cost that was incurred to produce the item that was sold that generated the revenue for us. Net sales is also revenue. How much money came in from selling the goods. Cost of sales indicate how much money did we spend to produce those goods to make that sale. The net of these two gives us what is called gross profit. So 186 minus 153, 33.3, that gives us gross profit. Then from that we subtract what is called general expenses. These are essentially salaries and overhead expenses. There may be some research and development expenses. And then over here we have depreciation, what we just discussed before. The annual depreciation of all of the fixed assets is noted over here, but we want to put this as an asterisk to note that this is just an expense item on the income statement, but does not have an actual cash outflow associated with that number. So the net of gross profit and all of these three items gives us what we call operating income. To that, we may add other income. Other income could be income from other investment sources, if we have any. If not, then it gives us what we call EBIT. From EBIT, we subtract interest expenses. Interest expenses are interest that the company has paid during that period of time to service all its debt. That gives us what we call pre-tax income. Also, we call that EBT, earnings before taxes. From earnings before taxes, we pay our taxes, and that gives us net income. When we take net income and we divide that by the number of shares outstanding, that gives us what we call earnings per share, or EPS. So over here, gross profit is revenue minus cost of goods sold. That gives us gross profit. Operating expenses is we take the gross profit from the previous line, subtract any operating expenses. That gives us operating income. EBIT, we take the operating income from this line, operating income from here, and then we add any other income to it. That gives us EBIT. And then from EBIT, we subtract interest income, and that gives us earnings before taxes. And then we take earnings before taxes, or EBT, subtract any taxes, and that gives us net income. Okay. It's easy to remember it in this standard format. This is a very standard format for an income statement. So net income divided by shares outstanding gives us earnings per share. If there are any stock options that, I'm not going to get into detail over here, stock options or shares that are can be issued due to conversion from convertible bonds, then our earnings can be further diluted by the presence of additional shares. And that's why you look over here, the diluted earnings are lower than the diluted earnings per share are lower than the actual earnings per share, meaning that there could be some shares related to employee stock options or from conversions from convertible bonds. Okay. EBITDA is a very popular variable that is used nowadays, where we essentially take a look at EBIT and we add depreciation to it. So if you look at over here, EBIT is here. This is EBIT. But EBIT includes depreciation. We know depreciation is a non-cash charge. So if I add depreciation over here, then this would give me what is called EBITDA, earnings before interest, taxes, and depreciation. It is a more pure form of earnings, because, and the reason we do this, because depreciation is not a cash flow. In another type of statement that is included in our in a company's financial records are what is called the statement of cash flows. And statement of cash flows is essentially not in any new information. It uses the information that comes from the income statement and the balance sheet to determine how much cash has the firm generated and how was the cash allocated during that period. And the reason this is done because cash is king. At the end of the day, what is tangible is the cash value, not some accounting book value. So that's why it is important to restate everything. And then one of the ways in which the cash flow is divided, it is divided into three sections: operating activities, investing activities, financing activities. Operating activities that are a result from actual operation of the firm, investment activities that are coming from investments that the firm has made, and financing activities that comes from any type of capital sources that the firm has used to finance its operation, either debt or equity. And this is the way it is classified. So here we have operating activities. What are the sources of cash that comes from operations? Of course, net income. We add depreciation back to it. Then we have effects of accounts receivable and accounts payable and inventory, which is essentially our net working capital adjustment. So we are subtracting accounts receivable, subtracting inventory, because those are the things that we will be paying out, and then we are adding back accounts payable, something that we will get in. So that gives us our cash flow from operating activity. In this case, there's a net loss from operation. Then there are investment activities that comes from capital expenditures. These are essentially expenditures in plant, property, and equipment. For this particular year, the company made large investments in plant, property, and equipment. Then there are financing activities. From financing activities, they indicate any dividends that the company may have paid, any increases in short-term borrowing or long-term borrowing. What it indicates over here that much of this capital acquisition, in this case, came from borrowing large amounts of money through debt. So at the end, the firm ended up with a net positive cash flow, but much of that net positive cash flow came as a result of borrowing, as a result of debt that the firm took on, mostly to finance the acquisition of assets, but also to make up for the deficit in its operating activities. That's why statement of cash flows are important, because it tells us a story about the firm. What did the firm do during this particular period? Where did money come from? Where the money was used? And what accounts for the net income that we see in the firm? Notice this. The firm had a net income of 2, but a cash flow of 2.7. Right? It has a net income of 2 million, but a cash flow of 2.7 million. So the actual cash flow of the firm was higher than what the net income suggests. That's why net income is slightly misleading number, partly because we have the presence of depreciation and amortization. But that's not the entirety of the story. That's why we look at the statement of cash flow. Again, operating activities, we are looking at essentially changes in net working capital, which comes from payables and receivables and inventory. Those are the 3 items that have impacted. Investment activities that come from capital expenditures, and financing activities that come from either a combination of what is happening in the equity side, dividends and purchases of stock, and the debt side. This is mostly equity, and this is debt. Now, at the end of the period, the company generates net income. Part of that net income can be paid out to the shareholders in the form of dividends. Whatever is not paid out is called retained earnings. Now, if we take the dividends, divide that by net income, it gives us the proportion that we are paying out. So dividends divided by net income. So if a company has a net income of 100 and it paid out $30 in dividends, that means its payout ratio is 0.7. Payout ratio is 0.3. That means 30% of its income is being paid out in the form of dividends. What is happening to the rest? What is happening to the remaining $70? It is going into that pot, the retained earnings pot. And where do we see retained earnings? We see retained earnings on the balance sheet. We don't see retained earnings on the income statement. We see retained earnings on the balance sheet. The key over here is to understand that the retained earnings on the balance sheet over here the retained earnings over here that we see, let me do this. Okay. So the retained earning that we see over here, in 2013, retained earning is 14.2. In 2012, retained earning is 13.2. So it shows that retained earning increased by 1 from 12 to 13, from year 2012 to 13. What does that indicate? That means income that was not paid out as dividend was added to this pot of 13.2 that led to the increase in retained earning. So retained earnings is a cumulative account. Whatever cash is being held in that account cumulatively over the years shows up as retained earnings. Okay, so we covered all that. And that ends the first part that we have for this chapter 2. The next thing that we will go into, you can review some of the problems and also review the problem tutorials. The next thing I want to get into is how to interpret the financial statements. We'll do that in the second part of the lecture.